Welcome back to Money Talks, your guide to the Canadian securities. We have some huge news to share with everyone today. After a lot of hard work, our new website, Mtalks.ca, is officially live. This is a game changer for anyone studying for the CSC exam. We've turned those dense textbooks into clear, easy-to-understand guides that actually make sense. No more memorizing, no more confusion. Just real understanding with examples you'll actually remember. And because we know practice makes profits, you'll get 2 full mock exams for each volume and tons of chapter quizzes to test your readiness before the real deal. Everything's built by finance pros from this very podcast, so you're learning from people who've been there and aced it. So if you're tired of drowning in jargon and want to walk into your exam feeling confident, go to Mtalks.ca. A huge thank you to our amazing listeners for your continued support. If you're new here, don't forget to subscribe, like, and share this episode with your friends. Your support helps us create valuable content to boost your financial education and career here in Canada. Today, we have our seasoned financial professional, Jonathan Cartier, back with us. Hey, Jonathan, great to have you on the show again. How's everything going in the market?
Hey, Rita. Thanks for having me. It's an interesting time. Canada's stock market is flexing hard this year, outpacing the U.S. like it just had a double shot of espresso. Even with slow economic growth and rate cuts from the Bank of Canada, the markets are booming. Mining, tech, energy, they're all shining, while big names like Shopify and RBC are leading the charge. Meanwhile, the loonie's getting stronger, bond yields are dropping, and investors are loving the calm north of the border. So yeah, the economy's yawning, but the stock market, it's throwing a party.
That's a fantastic overview, Jonathan. And maybe that's why alternative investments, strategies, and performance might be a key to thriving in this market. Could you talk about alternative investments, the role of strategies, and how they define performance?
Absolutely. Think of alternative investments as the specialized tools in a carpenter's toolbox. While traditional investments like stocks and bonds are your hammer and screwdriver, alternatives are your power drills and laser levels designed for specific jobs. These strategies aim to generate returns that aren't tied to the daily ups and downs of the stock market. There are 3 main categories of alternative strategies, each with its own risk and return profile.
Okay, so break it down for us. What are these categories?
The first is relative value strategies. These strategies try to make a profit from small differences in the prices of related securities. Imagine you notice that 2 nearly identical houses on the same street are priced differently. A relative value strategy would be like buying the cheaper one and betting that its price will rise to match the other. These strategies generally have low exposure to the overall market's direction. A classic Canadian example is an equity market neutral strategy. A manager might look at 2 major banks, say RBC and TD Bank. If their historical price relationship gets out of whack, the manager might buy RBC's stock and short TD's stock, betting that their prices will revert to their usual relationship. The goal is to profit from this correction, regardless of whether the entire banking sector goes up or down. Another one is convertible arbitrage, where a manager finds mispricing between a company's convertible bond and its underlying stock. They might buy the bond and short the stock to hedge their bet.
That makes a lot of sense. What's the next category?
Next up are event-driven strategies. These are all about capitalizing on specific corporate events. Think of mergers, acquisitions, or even a company going through financial distress. These events can cause temporary mispricing in a company's stock, and that's where the opportunity lies. For instance, with a merger arbitrage strategy, if Company A announces it's buying Company B, the stock price of Company B will usually jump, but often trade slightly below the acquisition price due to the risk the deal might not close. An investor might buy Company B's stock, betting that the deal will be completed and the price will rise to the full offer price. Then you have distressed securities, which involves investing in companies that are in financial distress, maybe even facing bankruptcy. It's a high-risk, high-reward play, betting on a successful turnaround.
So it's like being a detective looking for clues in corporate news. And the final category?
The final category is directional strategies. As the name suggests, these strategies involve making a bet on the direction of the market or a specific security. They have a high exposure to market trends. A popular one is the long-short equity strategy. A manager will buy stocks they believe are undervalued and will go up, while simultaneously short-selling stocks they think are overvalued and will go down. This gives them the flexibility to make money in both rising and falling markets. Then there are global macro strategies, where managers bet on big economic trends. For example, if they believe a country's currency is about to strengthen due to a change in interest rate policy, they'll invest accordingly.
This is all incredibly insightful, Jonathan. For our listeners who are enjoying this deep dive, just a quick reminder that you can find Money Talks on Spotify, Apple Podcasts, YouTube, Podbean, Audible, and of course on our new website, Mtalks.ca. If you're finding this valuable, please hit that subscribe button and share it with someone who might benefit. It really helps us out. Now, Jonathan, with all these different strategies, how do we measure their performance? It can't be as simple as just looking at the return, right?
Exactly. With alternative investments, traditional performance metrics don't always tell the whole story. We need to look at risk-adjusted returns. One key measure is the Sharpe ratio. It tells you how much return you're getting for the amount of risk you're taking. A higher Sharpe ratio is generally better. We also look at things like maximum drawdown, which is the largest peak-to-trough decline a fund has experienced. This gives you an idea of the potential downside. And time to recovery, which is how long it takes to bounce back from that drawdown. For more complex strategies, we also consider skew, which indicates if the returns are tilted towards the positive or negative, and kurtosis, which tells us about the likelihood of extreme returns or tail events.
That's a lot to consider. It sounds like doing your homework is crucial. What does the due diligence process look like for these kinds of investments?
Due diligence is paramount. You need to dig deep into both the investment manager and the strategy itself. For the manager, you want to know their background, their experience, and their track record. You should also look at their risk management framework and whether they have their own money invested in the fund. For the strategy, you need to understand the fund's objectives, how it uses leverage, its performance history, and the fees involved. Transparency is key. A good manager should be able to clearly explain their process and the risks involved.
So, who are these types of investments, particularly the more accessible liquid alts, suitable for?
That's a great question. Liquid alternatives, which are more accessible to retail investors, are generally suitable for those who have a good understanding of investment concepts and are focused on specific outcomes like improving risk-adjusted returns and diversification. They're often a good fit for investors with a medium-term investment horizon because these strategies can sometimes move out of sync with the broader market. You need to be patient. They're also for investors who prioritize liquidity but still want the diversification benefits of alternatives. However, they are more complex than traditional mutual funds, so it's essential for investors to work with a financial advisor to determine if they are a good fit for their portfolio and risk tolerance.
Jonathan, this has been an incredibly enlightening conversation. You've really broken down a complex topic into something much more digestible. Thanks so much for joining us again on Money Talks.
My pleasure, Rita. Always happy to be here.
And a big thank you to our listeners for tuning in. Before we sign off, we have a special gift to help you conquer your CSC exams. Head over to Mtalks.ca right now and download our free concise study guide. It's the perfect way to get a head start. And when you're ready to go all in, we've got an incredible deal for our podcast family. Get 20% off when you purchase our complete bundle. That's both Volume 1 and 2 full study guides, plus all the mock exams. It's everything you need to champion the CSC and take your career to the next level. Join us next time for another episode of Money Talks, your guide to the Canadian securities. Until then, stay informed and invest wisely.